conference last year. His name is Gregor Gregerson. He moved to Singapore several years ago and saw a niche that was missing in the market, which was selling physical bullion to people in Singapore. He ended up doing cash transactions at the train station, handing over bullion for bags of cash to start. And that told him that there was a real market. He ended up now, he at this point has a premier bullion dealership in Singapore, and he also has the leading world-class safe house in Singapore, which I don't remember the dollar amount, but it's I think close to $1 billion of bullion that is inside the safe house at this point. So I want to introduce Gregor, and he's going to be talking about a lot of the scandals that are in the business and why it's so important to have transparency in bullion storage.
Okay. So, yeah, thank you very much. So I just flew in from Singapore yesterday. It's been a 36-hour flight, so I'm kind of excited to be here. It's a little bit cold for me. I'm originally German, but now I've been living in Singapore, and Singapore is very hot. So, but yeah, adapting. So, as Colin mentioned, what I'll be discussing today is mostly experiences and the insight I have in the storage industry for bullion, wealth protection, so to speak. My background, I originally started out in finance, banking systems. I used to work with quants, building derivatives, structured product desks. I then ended up going more towards software development, business intelligence, eventually became a senior data architect for Commerzbank, one of the big German banks. And in 2007, I moved to Singapore because I really liked the way things were organized. And but by 2008, Commerzbank sent me back to Germany on an expat contract in my own country, which was nice because I got extra money and I still paid Singapore taxes. But 2008, Lehman Brothers went bankrupt. So I was in pretty much the trading room when the after effects of all of this came to be. And it really showed me how fragile our financial system really is. In many ways, if the banks stop trading to each other, then things just break down. And the wealth that you might think you have of the money in the bank, well, it's an IOU. You have complete counterparty risk towards the bank. And if for whatever reason they cannot fulfill that promise, then you have a problem. And the government either has to come in and do bailouts, or we're going to have bail-ins. Either way, when that happened, quite a number of people started buying precious metals. And I was sort of sitting there, and I was reading Mike Maloney's book, Investing in Gold and Silver, and I thought that might be a good idea. So I went out to try and buy some silver, and there was no way of getting it. I went to about 12 different bullion dealers in the Frankfurt area. They were all sold out. Silver prices kept on going lower, but there was no supply. Finally got a 1 kg bar in the gift shop of the European Central Bank. I took that back with me to Singapore, and when I arrived in Singapore, I was hell-bent on getting some more silver for myself and found out that there was no liquidity whatsoever for silver in Singapore. And I said, well, why don't I try to acquire some silver, see for myself, and since I know how to do this stuff, I'll build a website with live pricing and live inventory, put it out there, see if anybody wants to buy it from me, and then I can increase the amount of silver I have. And it was all very quite professionally made and so on, but the downside was when somebody bought, I actually would meet them at the train station because I didn't want to invest in an office and all these other things. After $600,000, we pretty much figured it's time to get an employee and to get an office, and that was 10 years ago. Since then, we had about 500 million US dollars or so in sales. Right now, we're storing about $250 million or so in gold and silver for customers, and we have about $80 to $90 million in loans that we facilitated, peer-to-peer loans between customers of our storage facility. So we found a legal way for customers to lend money to each other without having to be a bank. It's a peer-to-peer system. Essentially, we are a bullion dealership, we are a storage facility, and we are a software development house. We basically have 5 people developing code all the time, with me being the primary guy running this. And my motivation behind all of this is to make sure whatever gold or silver we store is safe for the next systemic crisis. It's safe against the nationalization of gold. It's safe against financial meltdown. It's safe against all of these black swan events which might be coming. And so I learned a lot about the industry since then, and that's pretty much what I'll be sharing. So to start off, I'm not sure if you ever heard of this, but there was a class action lawsuit of somebody called Silverplat with Morgan Stanley. Essentially, this gentleman bought a bunch of silver from Morgan Stanley, and he was told that the silver was bought for him. It's been stored under his name, and he paid storage fees. One day he decided he would like to take delivery of some of that silver, and then he found out that no silver had ever been stored. And he decided to sue. And that's 2 years later, in 2007, there was a settlement. And essentially Morgan Stanley said, well, it's industry practice not to store anything. And we didn't do anything against the law, because Morgan Stanley says that providing you with price exposure to silver or you owning physical silver is essentially the same thing. And of course the customer says, no, it's not the same thing. Morgan Stanley decided to settle outside of the lawsuit for $4.4 million, didn't admit any wrongdoing, and said that's just how it works in the industry. So that's a good example of, what's happening out there. Most people believe they own something when they don't. And that's something I spent the last 10 years to sort of get into and kind of share these sort of things to people. Because how do you know the bullion exists? Just because you have a statement, an IOU, which tells you that we owe you 100 ounces of silver or gold, doesn't mean that there's any gold. So typically when you have price exposure or something like this, the bank or the institution will hedge the price movement of that using the future markets. Now the future market are pretty much the connection between the financial world and the physical world. But if you go to your average future exchange, you will probably find that there's not more than around 2% or so of actual physical holdings compared to the net long positions that are being traded. So, and in 1998, those are interesting events that happened. Warren Buffett pretty much realized this, and he ended up accumulating 130 million ounces of silver. And then he said he wants to have delivery of all 130 million ounces. And there was no way that the future market could deliver on that. But if they didn't, they would be in default. So what happened is that they basically scrambled to try and find the silver. And the silver price went from $6 to $7.25. Went up about 20% because there was a request for delivery of the physical. And it just shows you how there's not that much of a connection. The prices at which silver is being traded in the future exchanges and the physical demand of something, they're not really interlined. It's only when you have a special event where you cannot come up with a physical, where there's actual influence between the two. So in this case, Warren Buffett, he managed to get about 88 million ounces, and 42 million ounces, he accepted a late fee. He accepted about 45 cents that the exchange had to pay him for delaying the payment. So he made 1.9 million or so out of that, as well as silver, of course, going up 20%. Kind of like what he did. So the question becomes, if you are in something like the future exchange, and there's only, say, 2% or 3% of actual holdings, how do you ever make sure that if you store something with somebody, that bullion that's present has not been sold many times over to other people? So here's a question I always tell people you should be asking. How do you know the bullion is there? How do you know it hasn't been sold over and over and over at the same time? when another point is that when Warren Buffett did this, and there was a scramble to get silver, what the exchanges did is they weren't really looking at buying silver. They were looking at leasing the silver. So it's quite common in the industry to have one party lease bullion from another party and then sell that bullion with understanding that at some point in the future you have to return that. And the chart you see over here is the interest rates that you have to pay for this leasing. So when Warren Buffett asked for delivery, it spiked up to 75% PA. Because basically the exchanges went everywhere trying to find silver and said, I'm paying you 75% per annum, which is about 6% per month, if you can give me the silver. And that's essentially brings up another question. How do you know that the bullion you store hasn't been encumbered? Because for all you know, you're storing your bullion with Company X. And Company X now leased it over to a future exchange so that the future exchange can deliver it to Warren Buffett or whoever is asking for delivery. So now we have three questions. How do you know the bullion exists? How do you know it's not been sold many times over? And how do you know it's not encumbered? So another interesting point is, if you look at the pricing of bullion itself, bullion prices are determined in the future markets, and there's very little, they're not influenced much by the actual physical supply and demand. And the reason is that in the future exchanges, you have 1 to 10 leverage normally. You have 900% leverage. So if somebody were to short silver, and say put $100 in a shorting position, that would create $1,000 of downwards trend. But if you have somebody buying physical bullion from a dealer, and that person hedges it in the market, this $100 will only represent $100 because there's no leverage on physical bullion. So your net effect will be that you have a $900 downtrend. In practice, that means that supply and demand or prices don't really reflect supply and demand in the physical world, unless there's some extreme circumstance. And we've been seeing this chart over here shows the price of silver since 2011. You see how it's went up and down, and you see how it has these 30% falls pretty frequently. And the chart below shows how much we were selling in silver at Silver Bullion between 2010 and 2015. So 2010, there was me selling it at the train station. And but the interesting point I would like to point out here is that whenever there was a big fall in prices, our sales jumped. And so we are in a funny position because we are selling a product whose price keeps on falling 30%, whereas the demand keeps on increasing. And the result is that we are running out of stock. And so we end up with shortages. So 3 to 4 times in the last 10 years, we couldn't get any silver. And the question then rises, why are prices falling like this? Well, most of the times that's not a good explanation. The prices the movement starts normally in the early morning on Monday, Asia time. The reason is because trading starts in Tokyo and is quite thin. So if somebody wants to push down prices fast, that's when they start shorting it. And silver is an excellent commodity to actually manipulate because it's the smallest big commodity. It's liquid, yet it's not very big, so you need less money to do it. So 3 times we had these 30% falls, and what will typically happen is that it will already fall in Asian time so quickly, so by the time Europe opens, and then especially the US, a lot of the small investors which might have long position, they will have margin calls already, or they might be forced out, because silver might be crashing 30% in a week. And whoever is initiating that, once it goes down low enough, they just kind of close the position by buying back some silver. But these are some examples which just illustrate how these big price swings can be orchestrated simply by shorting silver in the financial markets. And there's very little relevance to actual supply and demand, because when this happened, physical demand goes up because prices are lower, but we cannot get any of the bullion. So when we're talking about scandals, or it's a big picture sort of thing about precious metals, this is sort of an interesting insight. But having said all of this, at some point when we're going to have a financial crisis coming, a real systemic crisis, it is going to be the people who have the physical bullion who are going to be sitting pretty. Because just like in 2008, silver and gold prices ended up falling more and more, because as the market runs short on liquidity, everything gets sold. And that will cause downward pressure on prices for gold or silver. But the physical buyer, they will not be selling at those prices. They'll be holding on to the gold and silver. So there's going to be a premium increase for physical bullion. And that increase back in 2008 was about 300% at some point, at least in the secondary market. If I wanted to buy maple leaves, and I was looking at the height of the crisis, silver was $9. An American Eagle, I think at that time, was about $34 or so. A bullion dealer wouldn't sell it at all, but in secondary markets, that's what it was selling. So, and it is also because people wanted to have the real thing. During normal times, it doesn't matter. In a crisis, you have that big disparity. And so, having gone through these lessons, what we've been wanting to build is a system which is so insulated and isolated from the financial system, and it's only based in a trusted jurisdiction, does not have links to other jurisdictions, so that we can avoid being affected by nationalizations. And stores the value in a good which is going to do well if we end up having high inflation or hyperinflation again. When you put it all together, that asset is going to be gold, it's going to be silver, and it needs to be stored in a very transparent manner in a good jurisdiction. And that's essentially what we built. Yep. 5 minutes left? Oh my God. Okay, I'll try to speed up. So essentially the 4 questions are: how do you know it exists? How do you know it wasn't sold many times? How do you know it's not encumbered? How do you know it's genuine? And when it comes to storage, essentially you have these 5 models here. Price exposure is what Morgan Stanley was doing. There's no bullion behind it. Unallocated, that's more or less how the future exchange works. There's a small amount, 2%, to cover also bullion. And then you have so-called fully allocated systems. You might have ETFs out there which are using a fully allocated system. In theory, that means if you give them $100 of gold, they're going to buy $100 worth of, you give them $100, they will buy $100 worth of gold. The problem is it's still an IOU. So the downside of IOUs is A, you have low transparency because they don't have to give you a list of bars where these things, where they are and how they're going to be moving around. You have high counterparty risk because if they were to go bankrupt, you might not be getting your IOU filled. And keep in mind that if that ETF, for example, is part of a bigger bank, in a bankruptcy proceeding, these assets might be seen as belonging to the entire bank and not just the holders of that ETF. So these are some of the issues. You only get a generic IOU statement saying that you might be having 100 ounces or something. And more importantly, encumbrance is legal, meaning that bullion, because on the balance sheet of the fund, whoever owns it, can lease it out or use it for other purposes. And it's easy and fast to build such a system. In our case, we went the other way. We went with the idea of ownership, which is a lot more difficult to implement. And there are 2 ways: segregated ownership, which is a system we built, or you keep it yourself at home or in a safe deposit box, do-it-yourself model. When it comes to encumbrance, which is really one of the biggest problems with IOU systems, you can easily tell if you can buy bullion as a percentage. If you can buy $722 worth of bullion, as opposed to a fixed 100-ounce bar or whatever that unit comes, it's pretty much an IOU system. It's a telling factor. And what can happen with encumbrance? Well, if you're buying it from a bullion dealer, the bullion dealer might be using the bullion you buy as inventory. So he might be reselling that to other customers. I was interviewing somebody from another bullion dealer and I asked him what's going to happen if, say, we're going to have a crisis and you're no longer able to get inventory from suppliers and you sold the bullion that's supposed to be allocated for your savings account for your customers. What are you going to do then? He said, well, I'm going to change job. It's sort of the reality because it's such a big morsel. You get free financing for your bullion. Another example is leasing it to third parties. You might be aware that Germany was storing about 300 tons of gold with the Federal Reserve and wanted it back. And the Federal Reserve said, oh, it's going to take 7 years. It's not that it takes 7 years to ship it out because of so much gold. It's 7 years because most likely it was encumbered, meaning it was leased out to somebody else who sold it, and they were not due to return an equivalent amount of gold for these 7 years. Eventually, they got it back in 5 years, they did some sort of deal, whatever it is, but that's pretty much a reality of encumbrance. Another interesting point here is when it comes to the storage industry, when you're dealing with the dealers themselves, they normally don't store it themselves. They are going to outsource it to a commercial vault. The big names are Brinks, Loomis, Mark Armitt, and so on. And these vaults in return are going to be storing it in various countries. So when you have a system like this, there's detachment. And for example, if it comes to audits, it's really up to the vault to do the audits. When it comes to insurance, that's being done by the vault. If it comes to jurisdictional exposure, that's both the vault and the dealer. And when it comes to checking whether the gold is real, well, the dealer oftentimes doesn't see the gold. So only the vault is getting it, but the vault has no incentive to actually test it. So they store it on a set-to-contain basis. So there's really not much testing in the industry because nobody has an interest in doing so. When you're dealing with a dealer, what you should watch out for is the word ownership is one of the most misused words in this industry. You always say, oh, you have ownership of something, when you really don't. So the only way for you to know you have ownership is if you actually have an invoice specifying that a specific bar or parcel was sold to you, which signifies that it's no longer the balance sheet of the dealer. So that's the key thing to watch out for, but there are ownership claims all over the place. That's the term all-risk insurance. All-risk insurance is just a technical term, which means you all risk included unless excluded. In practice, it actually doesn't have much significance. If you think that you're going online, you're moving some bullion from one location to another, and now you suddenly have your bullion in Singapore, well, think again, because your jurisdiction where the bullion is physically doesn't matter as much as who's storing it for you. If you're storing it with a big international vault, and say I have exposure back to the US, they're going to have to follow US law, regardless where it is. And lastly, if you want to see your vault, oftentimes you'll be told, because of security reasons, you cannot see it. Because of security reasons, you cannot do this audit. Because of security reasons, you cannot do this other thing. Most of the time, that's not a good reason. Most of the time, there are other reasons why they don't want you to see the bullion. I'll speed up. What I have here are some examples of the clauses that you will have to sign as a dealer or as a private customer when you're signing up to a storage account like Loomis or Brinks or Malka. So the first one will say that shortages of or mysterious disappearance of unexplained loss from or damage to the goods said to contain in a parcel is not something that the vault operator is liable to. So even though the dealer might tell you that you have all-risk insurance, as part of the exclusions you normally will have mysterious disappearance. So you have to sign this statement. So really what you're looking for, if you're ever talking with a dealer, is do you have mysterious disappearance coverage? That's really what the closest thing to all risk. And the second point here, that pertains to jurisdiction. And if you are storing it with a global storage company, the global storage company is going to have global exposure. If the US is going to nationalize gold, it doesn't matter if the gold is in Singapore or in Uruguay or in Germany. The question is that provider going to follow US law or not? And just like big banks are going to have to follow US dictates pretty much, so big vault operators are going to also follow it. And you have to sign this statement in order to store. So that's essentially what we are doing different is that we started doing a company in Singapore, building the vault, and only storing in Singapore. So essentially we have exclusive Singapore jurisdiction. That was one of the major reasons why we had to build our own vault. We used to outsource to commercial vaults at first, but because of the clauses I just showed you, we basically had to insource it. So I apologize, there's very little time, I like to talk too much, but if you want to learn more about some of these things, I have some videos about an hour each of discussion on these topics. And at the end of the day, the reason this is relevant is we are going to have a big financial crisis coming again. I was just in China last month, and I was with a big manganese importer. They import 10% of manganese into China. And they were asking me if they need to buy manganese. I asked them why. And he said, Chinese government is telling us not to get manganese in China, not to get Chinese metals, leave it for the next generation, buy it outside of China. And another implication is get rid of all US dollars. China is getting more and more in US dollar debt because if they expect the US dollar to have a currency crisis, they don't want to hold a lot of US dollars. The Chinese are buying Italian ports now, they're investing heavily everywhere else, and I think within 5 to 10 years something bad is going to happen. And when that happens, it's good for your bullion not to be an IOU. You don't make sure that you have some of it at your own, your safe deposit box, or whichever way you feel comfortable. But keep it away from interdependencies, especially with the financial system. So that's pretty much it. Any time for questions? Okay. Thanks so much.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?